Are you of the belief that U.S. Treasuries remain the safest investment out there? We heard Alan Greenspan over the weekend saying, look, the U.S. can print money for as long as it wants and as much as it wants, so we won't default. Hence, Treasuries are the safest bet now. Do you agree?
Yes, we do. We think that the default risk for Treasury is de minimis. De minimis, right? It's not about people not wanting to lend to the Treasury. In fact, they're lending at lower interest rates today than they were on Friday. It's not about the fiscal situation being so urgent that everything's going to blow up. And it's certainly not about not having plan B. Unlike Greece, for example, the U.S. has a printing press. So the probability of a default is de minimis. However, what I think S&P is telling us is not that the U.S. is facing a higher risk of default. What S&P is telling us is in order to remain a AAA, you have to be able to grow, and you have to be able to maintain financial soundness. And right now, given what policymakers are doing, neither of these things are assured.
So what will Pimco's stance on Treasuries in terms of a desirable investment be looking forward? Where do you stand on them now? Outside of being safe, are they desirable?
So, you know, we do our own internal ratings. We have our own due diligence. We don't wait for the rating agencies to tell us whether something is AAA, AA, or whatever. So in terms of our investment strategies, nothing really has changed. And our investment strategies has always been look for safety, but look for it in a diversified manner. So focus not only on the U.S., but on the other countries, countries like Germany, like Australia, like Norway, like Canada, all of whom are AAA, all of whom are part of this diversified government debt basket. And what Pimco does is it looks at the highest relative value within that category.
Treasury is auctioning $72 billion in bonds this week. How are you expecting that auction to go?
A lot depends on whether the stock market calms down. So if the stock market continues to do what it's doing today, and hopefully it won't, but if it continues to do that, there will be a lot of flight to quality. And people will see this as a way to get size done. If the stock market does calm down, then it's a different issue. The major thing to look at now is what happens to the stock market.
You know, it's interesting when you look into this a little bit. Credit default swaps on U.S. Treasuries rose today. They're still below most AAA-rated nations. So it seems as though we're seeing investors giving the United States more credit than S&P is giving the United States.
Yeah, I think investors realize what I said to you, which is this is not a credit issue or a debt issue as much as it's a growth issue, right? It's the ability of the policymakers to get their act together. So what the markets are saying is, look, the signal is legitimate, but it means it has a much bigger impact on the risk market. So if you look at the high yield market, if you look at what's happening to commodities outside of gold, if you look at equities, that is where the damage is being created.
You said over the weekend in an op-ed that it's hard to imagine that having downgraded the U.S., S&P will not essentially downgrade at least one of the other AAA-rated sovereign nations. In your opinion, what country is at the most risk right now?
So the one thing to recognize immediately is that it doesn't stop at the U.S., and that's true domestically. So we're going to see a host of other downgrades that have to do with what we call the sub-sovereign level. So think about it. If the sovereign gets downgraded, those who depend on the sovereign cannot trade higher than the sovereign. So we're going to see a series of downgrades in the U.S. I think that's a certainty. It's not going to impact companies, but it will impact the sub-sovereign. When you go global, there's a possibility, not a certainty, but a possibility that other countries are questioned. And in fact, the market today is questioning France. And the reason why the market is questioning France is it sees that the debt level of France is higher than the U.S. It recognizes that unlike the U.S., the French have a downward path in the debt stock out there. However, the French seem to be committed to an open-ended support of the peripheral, which means lots of contingent claims on the French budget. So that's why the market today is showing concerns about France.